$9.3 billion in Treasury bonds, dumped in a single quarter. Not by retail investors panicking over headlines, by the smart money, the institutions that move markets, the players who see the exit before the crowd even knows there's a door. This isn't portfolio rebalancing. This isn't diversification. This is the final exit signal. The same pattern that played out before Spain lost reserve currency status in the 1600s. Before Britain watched the pound collapse in the 1960s. Before every reserve currency in history went from dominant to dead. And if you understand what's happening right now, you'll see why this $9.3 billion is just the opening move. By the end of this video, you'll know exactly what that means and why the next 12 months will determine whether you're positioned correctly or left holding the bag. Let's get into it. Section 1. The dump nobody's talking about. Here's what actually happened. In quarter 4 of 2023, foreign holders liquidated $9.3 billion in U.S. Treasury securities, not rolled over into new bonds, not shifted to different maturities, sold outright. And that number is just the visible part of a much larger pattern that's been building for 18 months. The Treasury International Capital reports show the full picture. Foreign central banks have reduced their Treasury holdings by over $200 billion since mid-2022. Japan, the largest foreign holder, cut its position by $63 billion. China dropped $40 billion. Saudi Arabia liquidated $28 billion. These aren't small players making tactical moves. These are the 3 largest foreign creditors to the U.S. government, and they're heading for the exits. Now, the mainstream narrative frames this as diversification. They'll tell you these countries are simply rebalancing portfolios, spreading risk across multiple assets. But that explanation falls apart when you look at the mechanism they're using. There's a difference between selling treasuries and not rolling them over. When a bond matures, the holder has a choice. Buy new bonds to replace the old ones, maintaining the same exposure, or take the cash and walk away. What we're seeing now is both. Active sales of existing bonds, plus a refusal to roll over maturing debt. That's not diversification. That's an exit strategy. The data proves it. In 2022, foreign participation in Treasury auctions hit a 15-year low. When the U.S. government issues new debt, foreign buyers aren't showing up. The primary dealers, the big banks required to bid at every auction, are absorbing more of the supply than at any point since 2008. And they're not holding it. They're flipping it to the Federal Reserve or to domestic institutions at wider bid-ask spreads. Those spreads matter. The difference between the price a dealer will pay to buy a treasury and the price they'll charge to sell it has been widening since early 2023. That's a liquidity signal. When spreads widen, it means there aren't enough buyers. Market makers have to take on more risk to move the bonds, so they demand more compensation. And that compensation comes in the form of higher yields. Which brings us to the real problem. Treasury yields are rising despite the Fed's stated policy goals. The 10-year yield hit 4.7% in October 2023, even as the Fed signaled rate cuts were coming. That's not normal. When the Fed pivots dovish, yields should fall. But they're rising because the marginal buyer, the foreign central bank that used to absorb unlimited supply, isn't there anymore. And here's the key. The players leading this exit aren't doing it because they need the cash. Japan's economy isn't collapsing. China isn't facing a sudden funding crisis. Saudi Arabia isn't desperate for dollars. They're exiting because they see what's coming. The same thing every reserve currency holder sees right before the system breaks. the debt spiral that makes the bonds worthless. Section 2. The three-stage exit pattern. Now, here's where this gets critical, because what we're watching isn't new. It's the exact same three-stage pattern that preceded every reserve currency collapse in history. And once you see the pattern, you can't unsee it. Stage 1 is diversification, the quiet phase. Foreign holders start reducing exposure while maintaining public confidence in the system. They don't announce it. They don't make dramatic moves. They just slowly, methodically, shift away from the reserve currency into other assets. Gold, land, alternative currencies, anything that holds value when the paper system breaks. Spain in the 1640s. Dutch merchants were the smart money of that era. They watched Spain's silver-backed currency start to crack under the weight of endless wars and mounting debts. So they moved, quietly, bought gold, bought productive land, shifted trade routes away from Spanish ports. By the time the Spanish crown noticed, the exit was already underway. Britain in the 1940s. The pound was the global reserve currency for over a century. But after World War II, the math stopped working. Britain owed massive debts. The empire was crumbling. So Commonwealth nations, the largest holders of sterling reserves, started diversifying into dollars. Not all at once, just enough to reduce exposure while maintaining the appearance of confidence. Today, we're seeing the same move. Central banks bought 1,037 tons of gold in 2023. That's the second highest annual purchase on record. China's official reserves jumped by 225 tons. Turkey added 148 tons. India bought 102 tons. These aren't small, symbolic purchases. These are strategic reallocations away from dollar-denominated assets and into hard money that can't be printed or sanctioned. Stage 2 is acceleration. The exit becomes visible in official data. The quiet diversification turns into measurable outflows. And that's when market concern kicks in. Because once the data confirms the trend, other holders start questioning their own positions. Spain in the 1650s. Silver flows reversed. The metal that built the empire started flowing out faster than it came in. Spain tried to stop it with capital controls and currency debasements, but that only accelerated the exit. By 1660, the silver-backed credit system was in free fall. Britain in the 1950s. The sterling crisis hit. Countries holding pound reserves started demanding dollars instead. Britain tried to defend the currency with IMF support and emergency loans. But the outflows continued. Foreign holders went from $7.8 billion in sterling reserves in 1950 to $3.4 billion by 1960. The exit was undeniable. Today, we're in stage 2. Foreign Treasury holdings peaked at $7.6 trillion in 2021. They're now down to $7.4 trillion and falling. That might not sound dramatic, but remember, the U.S. has been issuing trillions in new debt over that same period. So foreign holders aren't just reducing their percentage of total debt. They're reducing their absolute holdings while total debt explodes. That's acceleration. And here's what makes stage 3 inevitable. Once the exit becomes visible, the remaining holders face a choice. Stay in and hope the system stabilizes, or get out before the door closes. And every holder knows that if they wait too long, they'll be the last one holding worthless paper. Stage 3 is capitulation, the rush for the exits, the final phase where the trickle becomes a flood and the bond market collapses under its own weight. Spain in the 1660s. Total collapse of the silver-backed credit system. The currency lost 75% of its value in a decade. The empire went from global superpower to regional player. Britain in the 1960s. The pound was devalued 30% in 1967. Reserve currency status ended. By 1976, Britain needed an IMF bailout just to keep the government functioning. The pattern is undeniable. Stage 1, quiet diversification. Stage 2, visible acceleration. Stage 3, irreversible capitulation. And the $9.3 billion signal says we just entered Stage 3. Section 3, the debt spiral lever. Now let's talk about the mechanism that makes this collapse inevitable. The lever that turns a managed exit into a full-scale panic. The debt spiral. The U.S. government now pays over $1 trillion annually just to service the national debt. $1 trillion. Not building infrastructure, not funding programs. Just interest payments on money already borrowed. That's 15% of total federal tax revenue. And it's accelerating. Here's the math that traps the system. Every time the government needs to borrow more money, it issues Treasury bonds. Those bonds have to attract buyers. And when foreign central banks stop showing up at auctions, yields have to rise to pull in domestic buyers. Higher yields mean higher interest costs, which means the government needs to borrow even more just to cover the interest on existing debt, which pushes yields higher, which increases the debt service burden. The feedback loop locks in. At current rates, interest payments will hit $1.4 trillion by 2025. That's 20% of tax revenue. By 2030, debt service will consume 25% of all federal income. And that's assuming rates don't go higher, which they will. This is the trap every reserve currency faces in its final stage. The government can't cut spending enough to matter. It can't raise taxes enough because the economy can't handle the drag. So it borrows. And every dollar borrowed makes the next dollar more expensive. The Fed is trapped. If they raise rates, debt service costs explode. If they cut rates or restart money printing, the dollar collapses. Either choice accelerates the crisis. Section 4. The physical asset shift. So if the smart money is exiting treasuries, where's it going? The answer reveals the next reserve system taking shape right now. Central banks are moving into physical assets, hard assets that can't be printed, frozen, or sanctioned. Gold reserves are up 152% since 2010. That's not a diversification play. That's a structural shift away from paper promises and into tangible value. The data is undeniable. China added 225 tons of gold to official reserves in 2023. Turkey bought 148 tons. India grabbed 102 tons. Poland increased reserves by 57 tons. These aren't symbolic purchases. These are strategic moves by countries preparing for a post-dollar system. And here's what makes this shift critical. A two-tier market is emerging. The paper market, where most people think precious metals trade, is increasingly disconnected from the physical market, where central banks and sovereigns actually transact. The paper market runs through COMEX futures, ETFs, and derivative contracts. It's where price discovery happens for retail investors. But the physical market operates in vaults, bilateral trades, and central bank transactions. And the gap between the two is widening. Physical premiums are rising. The spread between spot prices on COMEX and the actual cost to buy physical metal and take delivery has been climbing since 2022. That tells you something. Paper prices are being held down while physical demand surges. The disconnect can't last. The BRICS nations are building the infrastructure for this new system right now. A gold-backed settlement mechanism launching in 2024 or 2025. Not a gold standard. A settlement system where trade imbalances get resolved in gold instead of dollars. That's a direct challenge to dollar dominance. And here's the opportunity most people miss. The same exit strategy available to central banks works at any scale. You don't need billions to position in physical assets. You need to understand the pattern and move before the paper price catches up to physical reality. Right now, the paper market is giving you the suppressed price, the price controlled by futures contracts and leverage. But when Stage 3 completes, when the Treasury exit accelerates into full capitulation, that paper price will snap to meet physical demand. And by then, physical metal will be impossible to source at any price. This is the positioning window, the phase where the smart money has already moved, but the crowd hasn't figured it out yet. The same window that existed in Spain before the silver collapse. The same window that existed in Britain before the pound crashed. The window closes fast once Stage 3 accelerates. Conclusion. The positioning question, the $9.3 billion dump, is the Stage 3 signal. The final exit is accelerating, and the choice in front of you is simple. Position in physical assets now, while the paper price is still disconnected from reality. Or wait for the crowd to figure it out and pay whatever price the market demands. Drop your thoughts in the comments. I want to know if you're seeing this pattern play out. Subscribe if you want these updates when the next signal hits. Because Stage 3 moves fast, and the only question that matters is whether you'll be positioned correctly when it completes.